Dr. Mohammad Sharifzadeh. He's a distinguished academic with a PhD in applied management and decision sciences from Walden University. He holds degrees from Oxford and Salford universities with over 25 years of experience. He has served as a dissertation mentor, a chair, a committee member while teaching finance and quantitative research. He is also a certified financial analyst and a risk manager, publishing in various peer-reviewed journals. Our second presenter is Dr. Simin Hojat. She holds a PhD in finance from Walden University, a master's in economics from Oxford, and a BA in economics from Tehran University. She has over 25 years of teaching experience, has served as a dissertation chair and a committee member since 2019. Her research is published in peer-reviewed journals focusing on finance, economics, and international trade. She has also 20 years of investment and economic research experience. So thank you for joining us today. I'll hand it over to the presenters.
Thank you very much. Thank you. I will present the first part. Hello, everyone. Thanks for coming and joining us for this presentation. You heard my name is Simin Hojat. I will be the first presenter. This is a joint paper, myself and Dr. Sharifzadeh. We were faculty fellow, and we did that as a member of faculty fellow 2023-2024. So let us start. Okay, this is the title of our paper, which is Impact of Environmental, Social Governance, and ESG Engagement on Financial and Risk Return Performance, a quantitative case study of trade of exchange-traded funds. This paper has already been accepted for publication in the peer-reviewed journal of European Journal of Business and Management Research. Let's talk a little bit about background, the story of exclusion or inclusion of some industry in the portfolio management goes back the early 20th century when it was based on business ethics. For example, in early 20th century, it happened that one of the most famous portfolio managers in that era excluded the alcohol and tobacco and gambling from its portfolio. Then we are seeing the era of high production and high productivity after World War II. And all of us and our fathers have enjoyed it. And after that, we see the byproduct that was, we call it as economists, negative externalities. So the negative externalities of all that production was the pollution, was the carbon emission, was somewhat the labors who have been hurt or even low quality products. So these had cost, and cost must be compensated by the producers. So what do we do now? The government came in and, for example, they had the tax on pollution, and the consumers' awareness globally, fortunately, forced or persuaded companies to sort of accept, to put some criteria, add some criteria to their decision-making, investment decision-making and capital budgeting, that besides their financial performance, generate some positive result for the society. That was the beginning of SRI, which we call it social responsible investment. At the beginning, it was cost, so they hesitate to do that, but after a while, empirically, it was proved that actually the companies that have involvement in SRI, they are doing better. Their performance is better. So more and more companies joined, and we are having this trend of SRI, then CSR, and ESG. At the beginning, it wasn't measurable what they did, so it was difficult for investors and portfolio managers to add this in their portfolio because they wanted to add the companies with more involvement. Involvement is CSR, which is corporate social responsibility. They asked for measurement, and the companies started measuring and ranking the companies based on their contribution to ESG, environment, social, and governance, which is the pillar of all these sort of three, SRI and CSR. And then it becomes something very attractive, and day by day more interest. The regulators came into the argument, and both internationally and nationally, they actually, the investors demand the disclosure of ESG rating, and the regulator more or less wanted those to be disclosed. In USA, we have Security Exchange Commission that the public companies report their financial statements every year and quarterly, and on 21 and 24 paid attention to that and enhanced to standardize these kind of reports in the financial statement. What is E? E is environmental risk factors such as companies' commitment to the environment, emission reduction, eco-sustainable product of development use, renewable energy, etc., etc. Social, workforce-related issues, firm commitment to the community health and safety of the workforce, safety and quality of the product, which is very important, and governance, which was related to the, for example, the board of directors, executive compensation, shareholders' right, corporate governance practices, and so on. And then finally, what was important is the combination, all of that, which is, we call it ESG, that some of the important investment companies, they put that into rating. So we have here the few rating entities provide numerical ESG score. They call it a score, and those were numerical. So it was easy for investors to decide on which company they go with. Morgan Stanley did that, Morningstar did that, and Reuters we have here. Morningstar is what we used, their ESG score, and because the way that they got their ESG scores was through something which they call EMI, the sort of materials that will affect the value of companies in the long run. They determine that for the industry and company, and they sort of rank the companies based on these numbers. The lower the better, from 0 to 100. So it made it very easy for investors and portfolio managers to select the companies that were involved more in ESG because it was empirically proved that they will be having more positive impact in their financial performance. The literature reports about 2 points. The literature is looking at this issue from 2 angles. One of them is the impact of ESG on financial performance. The other is on risk-return performance. If you are doing finance, you know that risk-return is always part of finance and financial analysis. So it impacts some results were positive, some results were negative, but mainly positive, especially the current investigations. And then what they haven't done enough, and we decided to do, was on ETF, exchange traded funds. If you don't know what they are, exchange traded funds are like mutual funds, with the exception that they can trade in exchanges like a share. So they have liquidity, and that is why they are very popular, the ETFs. So the ESG score for an ETF is the weighted average of the ESG for all the companies that are included in one ETF. And then that was what we used in our paper. Therefore, the purpose of our research was to examine both the impact and the risk return. We applied it to ETF, exchange traded funds. Model specification. First of all, the theory that we use, a stakeholders theory, that says that the value should be created for stakeholders. And then the 2 hypotheses, one was on the impact of ESG on financial performance. For financial metric, we considered ROIC, return on invested capital, and SG, sale growth. And for risk return, we considered Jennsen Alpha and Sharpe ratio. These 2 are the more pronounced risk return measures that all scholars use. The Jennsen Alpha or alpha shows the abnormal return, measures how well an investment has done compared with what it was expected or the average market. And the Sharpe ratio is the return per 1 unit of risk that usually they measure the risk by a standard deviation. These are the hypotheses. Hypothesis 1, these are the independent variable ESG, and carbon risks on financial performance, that there are 2. Then the hypothesis number 2, again, the same independent variable. The dependent variable, instead of the financial matrix, IORC and SG, we have the Jennsen Alpha and Sharpe ratio. So having said that, I finish and I give it to Dr. Sharifzadeh for the model.
Can you unshare, please?
Yes.
We get about 4 or 5 minutes left.
I have to go very fast, yes.
Yeah.
For the hypotheses that were mentioned, we developed 4 multiple linear equations, 1 for return on invested capital, 1 for sales growth related to hypothesis 1, and for hypothesis 2, 1 for Sharpe ratio, and 1 for alpha. These 4 equations, if we run them or examine them individually, we will increase our type 1 error substantially, and we don't get the correlation or covariances between the residuals of the independent variables. So we applied the structural equation modeling in a software called Stata. I go very fast with this. The population was all the US ETFs, and the sample was 100 based on the literature. And we did both for small ETFs and large ETFs based on the asset size. I go to findings very quickly. We use the PAS method in the structural equation modeling technique. This is the PAS. These are the independent variables, and the arrows show that they impact the dependent variables. In SEM, independent variables are called exogenous, independent variables are called endogenous. These are the results, and I give a summary of this result in a separate table. These are the dependent variables, these are the independent variables, these are the slopes, whether it is significant or not, or the sign is positive or negative. Because Morningstar Sustainalytics considers unmanaged risk, we expect to have a negative slope. The more risk, the less performance, or the less risk, the more performance. This is a summary. The interesting thing that we find is that the total ESG has negative significant slope on all of the for all of the dependent variable except for the sales growth. And the residual covariance matrix was significant for all the variables, which indicates that we need to include some more additional independent variables. This is model identification, which is the chi-square. All the metrics that are used for model identification were significant based on the literature. And equation level shows a high R-square of 0.82 or 82% of the variations in the dependent variables are predicted or explained by the changes in the independent variables, which is a very high effect size. Recommendation for replicate our model using a different sample from Sustainalytics Morningstar. Replicate our model using data from other sources. Enhance our model by identifying and including other independent variables as control variable, moderating variable, mediating variable, or confounding variable. And this is summary and conclusion. This is our references cited. In the paper, we cited about over 50 papers, but these are the ones that we just cited here. Any questions?
Okay, we have one question in the chat area. Someone asked, what is the difference between CSR and ESG, or the operational definition for this research?
Dr. Sharifzadeh.
Okay, CSR is voluntary company actions with regard to corporate social responsibility, and it differs from company to company. There is no standardizations, and there is no operational standard or commonly agreeable operationalization. While ESG is standardized, it is developed by rating companies, and it is a numerical measure, both ESG and ESG, and the surveys that they use have been validated and tested for reliability.
Great, thank you. Thank you. Are there other questions that were not put in the chat box? Let's see, Professor Marita, or is that just a thumbs up? Great. What? You have a question?
Hi, good afternoon. I did have a follow-up question. Thank you so much for providing the insights on the difference between CSR and ESG. So given that this research is looking at the impact of ESG on financial and risk return performance, who is your target audience? Would it just be the financial firms, or are we also looking to connect with financial officers at corporations?
It's mostly portfolio managers because we didn't do on individual companies, we did on the exchange traded funds. So our main audience would be exchange traded funds. Once they decide to get more engaged in companies that have low risk, low ESR risk, then the investors will get involved too.
Thank you. And just one more follow-up question. There's been a trend in the States with a lot of these companies removing their support behind DEI, and a lot of them are pointing to lack of funding that's running out, or they're pointing to the political discourse that's been happening around this issue. Would that have an impact on the data that you're trying to collect?
I didn't quite understand your question. Can you explain it, please?
Sure. So there's been a backlash with DEI. And so some of the data that we're seeing so far in the last 2 years is that there's a downward trend in the amount of investment that's being made towards ESG. And so I was just wondering, as you're collecting the data for this research, would that be some of the measures that you'll look at? Are you hoping to see that there might be an impact?
It could be one of the non-significant results that we got, could be because of this data problem that you mentioned. But the Securities and Exchange Commission is seriously following this environmental, social, and governance, especially environmental impact of companies. And very soon they are going to mandate it. So the quality of the data will become more transparent in the future. I think so.
Excellent. Thank you so much.
You're welcome.
Thank you for that question. We've got time for about 2 more minutes. Anybody else have another question? Okay, I want to thank the presenters today for presenting on this topic. Thank you very much.